The stock market just hit another record high. Gold just hit another record high. Silver just hit another record high. And if you think that means the economy is unstoppable, you're missing the message the market is whispering right in your face. Because when stocks and gold and silver are all breaking records at the same time, that is not a clean bull market. That is the fingerprint of cheap money. That is the unit you measure everything with getting weaker while prices float higher. Then the Treasury Secretary went on national television and said the quiet part out loud. He called 2025 good, but he framed 2026 as the feast, the banquet, the bigger course. That is not a casual metaphor. That is a signal. Most people heard it and clapped. Investors heard it and smiled. The stock market heard it and kept dancing. Gold heard it and warned. Silver heard it and screamed. I'm your host, and this is our breakdown of the warning the stock market is ignoring, what the metals are actually pricing in, and why the real story of 2026 is not earnings, not hype, not headlines. It's the flow of newly created dollars. Here's the core idea, stated as bluntly as possible. Stocks can rise because companies get better, or stocks can rise because the money gets cheaper. In the early years of a strong expansion, fundamentals do most of the work. In the late stages of a cycle, liquidity does. And liquidity is just a polite word for dilution. If you've ever watched a magician do a trick, you know the move. The audience is staring at the shiny hand. The real action happens in the other hand. The stock market is the shiny hand. The other hand is the printer. When the government spends more than it collects, it borrows. When borrowing gets heavy, policymakers try to reduce the pain. They talk about supporting growth. They talk about financial stability. They talk about keeping conditions orderly. But the mechanism underneath is always the same. Easier money. Lower rates make debt cheaper. Cheaper debt expands credit. Expanded credit pushes money into assets. That is how you get record highs, while regular people feel squeezed. So when you see gold and silver ripping alongside stocks, don't treat it like a party. Treat it like a smoke alarm. Gold is not going up because it suddenly discovered a new use case. It's going up because it is measuring the erosion of purchasing power. Gold is the currency's report card. Silver is that same report card with a megaphone. It's smaller, more emotional, more volatile. But when it breaks records with gold, it's usually because the monetary story is leading the dance. Now here is what you are being sold by the comforting narrative machine. You're being told inflation is contained. You're being told any slowdown will be soft. You're being told rate cuts will be gentle. You're being told the system is stable. But the metals are pricing something harsher. They are pricing a pivot toward more liquidity. They are pricing policymakers choosing the painkiller instead of the surgery. And you don't need to be a conspiracy theorist to see it. You just need to understand incentives. A market crash is political poison. A recession is a confidence killer. A falling stock market is a headline disaster. The people who run the policy machine do not want 2026 defined by pain. So the default move is support. Support means spending. Spending means borrowing. Borrowing plus pressure means easier money. Easier money means the currency unit buys less. That's the chain. And that chain is exactly why you can have a year where stocks are up, gold is up, silver is up, and the average family still feels like the ground is moving under them, because wages move slowly. Assets reprice fast. Your paycheck is a treadmill. Asset prices are an elevator. If you're only on the treadmill, you can run hard and still stay on the same floor while owners rise. Now let's talk about the hidden transfer that nobody wants to label honestly. When new money enters the system, it does not land equally. It hits markets first, it hits institutions first, it hits asset owners first, then it shows up later as higher prices for everyone else. This is why the same policy that looks like growth on TV can feel like struggle in real life. And this is why record highs in gold and silver matter. They are not just charts. They are signals that the transfer is underway. Now here is the part that makes people uncomfortable. If you do nothing, you're still making a bet. You're betting the currency will hold its value. You're betting your wages will outrun inflation. You're betting your savings won't be quietly diluted. You're betting the system will be gentle. Gold and silver breaking records are telling you that bet is getting riskier. And the stock market, ignoring that warning, is exactly how people get blindsided. The crowd celebrates the boom, and then they wake up to a cost of living that feels like it doubled. So the question is not, are record highs good? The question is, why are we getting record highs in everything at once? Stay with me, because in a moment I'm going to show you the 3 switches that can push 2026 into a liquidity year, even if the economy stumbles, and why that is both an opportunity and a trap for anyone who isn't positioned. I'm your host, and this is the breakdown the headlines won't give you. Here's the core idea. Stocks can rise because companies get more productive. Or stocks can rise because money gets easier. When money gets easier, valuations inflate. That is not morality. That is math. Gold and silver are different. They don't need earnings. They don't launch products. They don't buy back shares. They rise when trust in the currency weakens and when people want to hedge against policy. So when you see gold and silver beating the stock market in the same year, it's rarely a victory parade. Historically, it tends to show up around stress points. Not every time, but enough that ignoring it is reckless. This is why that triple record week matters. The stock market is doing what it does when liquidity is plentiful. Gold and silver are doing what they do when people suspect the liquidity is about to get even more plentiful. And then the Treasury Secretary used the word feast for 2026. Think about how wild that is. Officials don't frame the next year like a celebration unless they're signaling a stance. They're telling institutions, managers, and markets, expect support, expect activity, expect a bias toward higher asset prices. Most people heard that and thought it was comfort. It's not comfort. It's a clue. Because a feast has to be paid for. And in modern finance, the bill is often paid with dilution. Let's talk about what dilution actually looks like in real life. It doesn't arrive as one dramatic announcement. It arrives as 1,000 small price changes. Rent creeps up. Insurance jumps. Groceries reset higher. Extra becomes normal. And then you look at your savings and you realize your money did not grow, but your costs did. That is the invisible tax. And it hits hardest when you're holding cash, holding low-yield savings, and relying only on wages. Because wages are slow. Wages negotiate. Wages have friction. Most people get a raise that sounds okay until you compare it to the total cost of life. And when your raise is smaller than the rise in costs, you didn't get richer. You got poorer with a better label. Meanwhile, assets reprice faster. Stocks reprice. Real estate reprices. Commodities reprice. Even collectibles reprice. Why? Because new money flows into scarce things first. This is the part nobody wants to say out loud, but it is how the system is built. The public companies are legally incentivized to maximize shareholder value. Executives are evaluated on share price. Boards reward share price. Compensation is tied to share price. So when policy makes money cheaper and pushes assets up, corporations do what they were designed to do. They enrich owners. Now layer on the tax structure. If you earn only as a wage earner, you typically face the highest marginal tax treatment and the fewest structural advantages. If you earn as an investor, you often get lower rates on long-term gains and access to deductions and deferrals that wage earners don't. You don't need to like that. You just need to understand it. Because if you don't understand it, you'll keep asking, why does the stock market look fine while my life feels more expensive? That is the answer. The system rewards ownership during a dilution cycle, and that brings us back to 2026. If policymakers want a feast, they have 3 big switches they can flip. Switch 1 is deficit spending. Spend beyond revenue. Borrow the gap. Keep money moving through contracts, programs, and demand. Switch 2 is easier rates. Lower the cost of borrowing. Encourage refinancing. Encourage new credit. Encourage a new round of risk-taking. Switch 3 is balance sheet support. Call it easing, call it liquidity operations, call it stabilization. The effect is the same. More reserves, looser conditions, less stress in markets. When all 3 lean in the same direction, you get what looks like prosperity on a chart. But here's the cliffhanger. That kind of prosperity can be real for asset owners and still be dangerous for everyone else. It can lift prices and still hollow out purchasing power. And the metals are the early warning system for that hollowing out. Gold doesn't scream, it signals. Silver doesn't whisper, it alarms. So when silver's breaking records too, the message gets sharper. This is not just optimism, this is hedging. Now, let's get even more specific about how the feast narrative can play out. If rates come down meaningfully, look at what happens to housing psychology. Buyers who were frozen at high mortgage rates suddenly see affordability improve. Even a modest drop can pull demand forward. Then look at homeowners. People sitting on a high rate see a door open. They refinance. Some of them do cash out refinancing. Suddenly they have fresh spending power without earning more. That spending flows into the real economy. It becomes corporate revenue. It becomes earnings. The stock market cheers. But the currency pays the bill. Because easier credit doesn't create new goods instantly. It creates new demand instantly. And when demand rises faster than supply, prices rise. Now add government spending on top of that. More projects, more procurement, more directed investment, more programs. Corporate profits can rise because the customer base is being subsidized by borrowed money. Again, the chart looks great. But gold and silver are watching the same flow and saying, this isn't free. This is being financed by dilution. That's why the stock market can be euphoric while metals are still bullish. They're not contradicting each other. They're describing the same phenomenon from 2 angles. And the stock market ignoring the warning is exactly how people get blindsided. The crowd celebrates the boom, and then they wake up to a cost of living that feels like it doubled. So the question is not, are record highs good? The question is, why are we getting record highs in everything at once? Stay with me, because in a moment I'm going to show you the hidden trap inside a liquidity boom, why the volatility will be weaponized against you, and how to think like an owner instead of a spectator. Here's the trap. In a liquidity boom, prices can rise in a straight line until the day they don't. And when they stop rising, they don't gently drift, they snap. That snap is usually not because the story changed. It's because leverage got squeezed and risk managers hit the brakes at the same time. That's why a liquidity year can be both the biggest opportunity and the biggest psychological test. The new money lifts markets, but the institutions use volatility to harvest weak hands. They don't need you to be wrong, they just need you to be emotional. A sudden 5% drop makes people panic, they dump at the bottom. Then the market bounces on the same liquidity that caused the rally in the first place, and the people who sold are left watching from the sidewalk. So if 2026 becomes the feast year that officials are hinting at, the question is not just, what should I buy? The question is, can I hold through the noise long enough to benefit from the flow? Now, let's talk about why the average person gets crushed in this environment. If you're paid a salary, your income adjusts slowly, your landlord adjusts rent fast, the grocery store adjusts prices fast, insurance adjusts premiums fast, tuition adjusts fast, your paycheck does not. So while the headlines scream market up, your life feels more expensive. Meanwhile, the person who owns assets has a different experience. Asset prices reprice upward as the currency weakens. Stocks, real estate, commodities, even businesses that can raise prices. Owners can pass inflation through, workers absorb it. This isn't about being smart. It's about which side of the balance sheet you're on. And here's a detail most people never learn in school. Public companies are not built to make employees wealthy. They are legally and structurally designed to prioritize shareholders. Executives are rewarded when the share price rises. Boards evaluate leadership through the lens of investor returns. That's the machine. Now stack that on top of the tax system. Labor income tends to be taxed at higher rates. Long-term investment gains often get preferred treatment. You don't need to memorize the brackets to understand the direction. The system leans toward rewarding capital more than it rewards labor. So when the money printer speeds up, you get a double effect. Prices rise against wages, and the winners get tax advantages on the gains. That's why gold and silver breaking records is not just a trade. It's an X-ray of the system. It's the market admitting, in real time, that the purchasing power of the currency is being sacrificed to keep the asset machine alive. Now, I'm not here to tell you to panic. I'm here to tell you to stop being surprised. Because doing nothing is still a decision. Doing nothing means you're choosing to hold the currency and hoping it keeps its value, while officials openly talk about bigger growth and more momentum next year. If you understand the game, you don't have to love it, you just have to play it. So what does play it mean in plain language? It means you build exposure to assets that can reprice when the currency weakens. It means you diversify across things that respond to liquidity. It means you think in real terms, not just nominal numbers on a screen. It also means you respect risk, because liquidity can lift markets, but it can't eliminate volatility. You can still get drawdowns. You can still get corrections. You can still get a scary headline designed to make you sell. That's why the best move for most people is not to swing for one perfect bet. The best move is to stop being underallocated to ownership. And that circles us right back to the warning. The stock market is celebrating the record high because it sees the banquet. Gold and silver are celebrating the record high because they see the bill. That bill shows up in the cost of living. It shows up in the value of your savings. It shows up in how far your paycheck goes. So here are the two questions I want you to answer in the comments. First, do you believe these record highs in gold and silver are a warning about currency dilution, or do you think they're just momentum chasing? Type one word, warning or momentum. Second, if rates come down in 2026, who benefits first, in your view, workers or asset owners? Tell me why, because your answer reveals whether you're looking at the economy through wages or through balance sheets. And here's my final point, the one that matters. A liquidity boom can make you feel rich while quietly making your currency poorer. That is the illusion. If you want to win, you stop chasing headlines and you start tracking the flow of money. You watch spending, you watch rates, you watch the central bank's posture, and you watch the metals because they often move before the talking heads catch up. If this analysis helped you see the signal behind the noise, subscribe. Short, simple, and it keeps you plugged into what the charts are really saying. Because the market isn't ignoring the gold and silver warning by accident. The market is betting most people won't understand it until the next phase hits. Stay sharp, stay focused. I'll see you in the next one.